Welcome to the Second Bite Podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
So welcome, Todd Taskey here, your host with the Second Bite Podcast, where we get an opportunity to talk with entrepreneurs and CEOs about building and then selling valuable businesses. And I think what people really love about this podcast is that we talk to somewhat unknown CEOs, but still CEOs who have built 7 to 8 figure companies, have sold them for real cash, and are now aggressively working on their second bite at the apple. These are the type of people that I work with. So if you want to talk more or learn more, you can reach out to me through LinkedIn or through the website at potomacbusinesscapital.com. I'm really super excited for our call today and our interview today with Don Cantonez from Cohen. Don, welcome to the podcast.
Thanks for having me.
Hey, and Don, just before we get started, I do want to thank the good people at Cohen as our sponsor. Cohen is a full-service CPA firm in Rockville, Maryland. They provide a full suite of tax and consulting services. Don, in particular, can take your financials and make them look beautiful for a buyer or an investor, as he has helped me many times. The people at Forbes say that Cohen is one of the most recommended CPA firms in America. They are always on the best place to work list. So thanks to our good friends at Cohen, and you can find them at ecohen.com. So with that said, Don, again, thanks for joining us. Maybe, if you will, give just a quick intro, maybe for a minute, on you and your history, because as I always describe it to clients, you have spent a vast majority of your long career actually doing due diligence for private equity firms when they look for expertise going into a transaction.
Yeah, that's true. With a little bit of clarification. So I've been in the sector for just over 40 years. I hope I don't look my age because I just gave it away. But I started my career with a national firm 40 years ago. And I started as an auditor, and I have been an auditor throughout my career, although I've tried to limit my focus on auditing no more than 50% because, frankly, I'm much more interested in the consulting side. And the way I describe consulting is the problem-solving aspect. I like helping clients solve problems. I'm somewhat entrepreneurial by nature, despite the fact that, again, that I've been with 2 national firms. I was with McGladrey until 2012, where I was a partner for just about 15 years. Again, somewhat focused on the audit side, but with a lot of M&A work, because there are a couple of industries where my expertise was such that I was sort of the head of the due diligence aspect on certain types of clients. So I've done a lot of M&A work. I've done it from both sides. So representing buyers in their due diligence, representing sellers and having to prepare for due diligence, which I sometimes pithily tell them is just get ready to prepare yourself for as if you would for a proctology exam. Because that's and about as enjoyable. But here's the thing, Don. It's enjoyable.
Right. But I say this to clients all the time, because what you do for me and for our clients is you pull it apart and you put it back together. And you do that in a friendly environment, number one, so that we can make what adjustments that we need to. And we do that because, and I'm going to get into my first question here, you've been involved in tons and tons of deals, right?
Absolutely.
The financials send a signal to the buyer. And you've seen plenty of these, and I would imagine there's certain things, and we're going to get into real granular stuff as we go here. Maybe you could just talk about, because this is one thing you've educated me quite a bit on, particularly with the deals we work on that are usually between, say, 5 million of revenue and maybe 30 million of revenue. Talk about the signal that sends when the buyer takes a look at your financials for the first time.
Okay. Well, let me preface that by saying that, what did you want to emphasize? I've been on the buyer side literally more than 100 times. So I know what buyers are looking for. And that is what helps me assist companies who are looking to sell with the expectations they should have going in. One of the things buyers are looking for when they look at financial statements, first of all, obviously, the very first thing that you're going to look for is you're going to look for financial indicators that let you determine is this a company worth pursuing or not. Now, there'll be non-financial things that a typical buyer is going to already have some intelligence on. It might be about the company's position in the marketplace. They may know where that company stands. They'll have heard of them. But ultimately, buyers buy companies either as pure financial plays or strategic plays, one of the two. But they're not going to buy a strategic play that's a financial disaster. No one wants that. So they're looking at financial statements to see, more often than not, the first two things you're probably going to look at are revenue and, in particular, the revenue trend. All right, so you're not looking for a static revenue trend in a dynamic company. You're not looking for you're looking for revenue growth, or occasionally the diamond in the rough where you might not perceive any recent historical growth, but you think that with proper management, meaning your management as a buyer, you can change that because maybe there's some distinct, unique product or service or ability that company has. The second is going to be some measure of financial bottom line success. And that can be net income. More commonly in the marketplace, it's EBITDA, because that's a better measure of cash flow. Buyers are less interested in pay for profits than they are in cash flow. So that tends to be the distinguishing thing in the marketplace. But there are exceptions to every rule. But those are the two things that we first look at. And then, of course, the next thing, and we'll get into this in a minute, is the question becomes the credibility of the information they're saying. You're going to hear me use that word probably a lot. Credibility. If I've represented companies on the both the buy and sell side as large as $1 billion. That's by no means the majority of my work, but in a national firm, you tend to see bigger deals. And even a $500,000 company buying a $100 million company, the odds are the $100 million company will have been getting regular annual audits from a CPA firm. So the buyer is going to have some initial comfort just based on that fact. And one of the things they're going to do in due diligence is go look at CPA firms' work papers and ask them a bunch of questions. When we're talking about the 5 to 30 million range, that more often than not is not an option, as you know. Relatively few of the companies that we're working with or have been working with get annual audits. A couple have. And there's also two other levels of service the CPA can provide. One's called a review, one's called a compilation. They're lesser than an audit, successively lesser. Even a review is helpful. But again, most companies will not have thought about getting them, particularly the high flyers that don't have to rely on bank debt. So if your company's not, traditionally, lenders have provided the impetus for a company to get its financial statements audited or reviewed, and very occasionally compiled, because that's not really all that worthwhile. But we don't see that as much in some of the tech and digital marketing areas that are more service-oriented, not capital-intensive, and therefore, don't do a lot of borrowing, or to the extent they do, it's just to finance something that we're going to be talking about, which is called working capital.
Got it. So that part's helpful. One of the things that I have found is, and I am going to share my screen while we're talking about this, because I think it's helpful. Let me do this. So I've done many presentations with folks, and what I've found is the feedback I get when I talk to somebody, I tell them that because most of the transactions we do are considered lower middle market, right?
Yep.
You can see my screen, okay, Don?
Yes, I can.
Okay. So we're in the lower middle market, and we're going to tell every potential buyer out there that the transaction is going to be a simple transaction. The buyer never believes me, right? Because everybody says that, and in a smaller, they're just as difficult, sometimes more difficult as a larger transaction.
Right.
When we show these financials, what I find is that there's a sigh of relief that somebody knows what they're doing, right? And,
Absolutely.
And so, as you see here on the screen, this is the kind of the most important page that I always look for. And you'll see that this is dated, and it doesn't matter. It's really the format, but it shows the trend that you talk about from, in this case, was 15 to 18. It shows revenue growth, and then it's broken down here at the bottom. It shows the same from a balance sheet. It shows it each year. We show the adjustments that we talk about. We can scroll this thing all the way out. We talk about deferred rent. We talk about all the things that a buyer's going to eventually uncover. You have uncovered for them right up front from the beginning. And I know that when I send something of this magnitude for a company that is, call it $10 million, or for example, you'll see this business was an $8 million, digital marketing firm. But when you look at a company like this, it gives that degree of comfort almost right off the bat that somebody knows what they're doing. And this actually might be an easy transaction. And again, you prepared many of these for me. Any comment that you would add to this before we move off that point?
Well, two things. One, if you would scroll to the top of that page. Now, this is what I would describe. At first blush, if I'm a buyer, Todd's got a challenge on his hands here. The buyer's got a challenge on his hands. Because if we look at the trend here, okay, we go 7.9 to 8 in the sales trend, 7.9 to 8.5, down to 7.5, back up to 8.4. So essentially, the company's had a 2018 year that was slightly lower than its 2016 year with a significant. It's one of the very first things the buyers are going to look at. One of the very first things they're going to want to know is what's going on here. And why should this company be attractive to me? It looks kind of like an up and down. I'm thinking as a Washington Nationals fan before Bryce Harper left. You get the 2015 and 2017 Bryce, or the 18 and 20 Bryce. I think I have the years off. But basically, there's 1 year where he won the MVP and 1 year where he nearly did, and then 2 others that weren't all that. So all the work that you see to the right on those tabs is to get to reliable numbers on this tab, and there's one to the left. It should be a balance sheet to the left. If not, then I'm not sure where the summary balance sheet is, but it's to get to these. And let me introduce a term here so that I won't have to repeat it constantly as we go on. There's what we call in the accounting profession, we call generally accepted accounting principles. Generally accepted accounting principles. We use the term GAAP to describe this. And so when you hear me mention the term GAAP from now on, I'm not talking about a sudden drop or a missing link. I'm talking about the set professional standards, and these are set by a professional standard setting board that even the Securities and Exchange Commission recognizes, and they're the accounting standards that companies are supposed to follow, and the results of those standards are what auditors audit to see if they've complied with it. We call a company GAAP compliant. If they've done that, and then if you're getting an audit, for example, you're going to get what's called a clean opinion if you've complied with GAAP. So one last time, generally accepted accounting principles, and this is an exhaustive set of principles. It's very detailed. It's very technical. It's why people go to college to study accounting for 5 years.
And all of that goes to build confidence that we're kind of working and thinking from the same thing, number one. And just to touch on it quickly, when you look at this page and you hear this from Don, 2 things I would point out. Number one, this typically costs $4,000, $5,000, $6,000, depending on where we're starting from. And all it takes, Don, for you to prepare this for most of my clients is access to their QuickBooks file. So when I have clients that hear that, they say, wow, really? Done. And then it takes maybe about a week to get produced. And I will say, more than just having produced financials, which people love, they learn a lot from what they have seen in this presentation.
Right. And I would point out to your viewers, those tabs you see that say AJEs, 2017 AJEs, AJE stands for Adjusting Journal Entry. And those are the entries that we are locating and finding that need to be made to get the books to a reasonably GAAP basis. And I think this is a good chance, a good opportunity to say something also about QuickBooks. Okay, QuickBooks has been around for, I'm going to guess, 20, 25 years now. And it was the natural successor to the personal finance software Quicken. Intuit decided, hey, if you do it for individuals, you can do it for business. Now, let me say up front, QuickBooks is the bane of most CPA firms, okay, because it is a relatively simple, easy to use accounting program that is laudable in one respect: ease of use and the ability for lay people to understand it to some degree and devise reports. But where it becomes problematic is that it allows less skilled people to literally maintain sets of books. And so entrepreneurs by nature are typically focused on a few things, right? I think I'm speaking to some entrepreneurs right now, they're probably checking the mail every day to see what cash came in, how much cash is in the bank. They talk to their tax CPA at the end of the year to see how much tax they owe. And they assume that their taxable income is somewhat reflective of their, what I'm going to call GAAP income. It almost certainly isn't. And they're looking at the bottom line, monthly in QuickBooks. But let me really emphasize this. They have no assurance what they're seeing is accurate because they're either farming it out to some probably small firm outsourcing that is not well equipped to understand GAAP, or they have an internal person who's a bookkeeper, and there's a distinction between a bookkeeper and an accountant. An accountant is someone with a degree, and then the CPA is a degreed accountant who's passed a rigorous exam. The analogy I would use somewhat, this is a little unfair to mechanics, but I'm going to do it anyway. I have some friends with mechanics. I hope they're not watching this. But a mechanic, the guy that fixes your car, is not the same as the engineers who design it.
That's really well said. And let me just follow up on that concept for a second, Don, because buyers love entrepreneurs, but when they buy something, they want a CEO. They want somebody that understands their business and their financials. It doesn't mean they have to prepare them. It means that they need to understand the importance of them. And you, I think more than anyone, have taught me the credibility you get in a deal by looking like this at the very, very beginning. And I'm going to use that to lead into my next question. When you look at, and I know you've worked with all sizes, which is why this question will be so helpful. When you look at a company, let's call it 10 to 20 million of revenue,
yeah,
what's the biggest mistake you oftentimes will see in their P&L that maybe the CEO is not even aware of?
Okay, so all right, the first one is, and this is really important, so I'm gonna spend a few more minutes on it, and I'm gonna be a little bit technical here, so I hope people will excuse me, but it's necessary. Until about 3 or 4 years ago, GAAP, the GAAP guidance. Now remember, this is official. These are a set of official standards. It's as thick as the Internal Revenue Code that companies are supposed to abide by, and that CPA auditors and so on must abide by in performing audit statements. Probably this is one of the single most important elements of the financial statement is revenue, and the profession began to discover that the revenue standards were a hodgepodge, which is why you had companies like Enron and WorldCom and Xerox got dinged, but they're probably not as well known. But certainly everyone's heard of Enron, and probably a lot of people have heard of WorldCom. At the beginning of the 2000s, you had a lot of companies being forced by the SEC to restate their revenues because they were not in accordance with GAAP. They were taking advantage of what we frequently refer to in the tax code as loopholes, so we might as well do the same with GAAP. So the standard-setting bodies went on a multi-year project, and around 3-4 years ago, after many fits and starts, came out with a comprehensive revenue recognition standard. It is complicated. Entrepreneurs think of, and many non-entrepreneurs, many people who are, with long, who think of revenue as, hey, the money that comes in is revenue, that's that. It's not that simple. It is much more complicated than that. I don't want to get into the real nitty gritty, but suffice to say is there's a lot of analysis that has to be done as to the company's contracts and sources of revenue to determine when that revenue is properly recognized under GAAP. And your average entrepreneur is not going to be, your average CEO is often not up on this because I think the hiatus got it twice. And you as a CFO, you're really occupied, if not inundated, with the daily duties of the treasury function, making sure the bank is happy, analyzing the operations of the company, budgeting, doing a whole lot of other things. And keeping up with GAAP becomes an increasingly less important thing.
Right. So let me give an example, and you can comment on that. I'm going to give two, so we'll do it one at a time. So let's assume somebody is in a project-based business, and the project is $50,000. Okay. Yep. And let's just assume that it's going to take 5 months to complete. And let's assume they're going to complete 20% of it every month. And of course, that never happens in the real world. But that's the dynamics of our example. So an entrepreneur typically will take the 50 grand, book it in as revenue, and then they'll perform on this great client, and then they'll have 50 grand in their account. The way that it's supposed to be accounted for, as you know, if I got it today on June 1st, I've earned 0 of that 50 grand. I haven't done any of the work.
Right.
So what I'm supposed to do is put 50 grand in my bank account and put 50 grand on my balance sheet as a deferred revenue liability until I've done the work. The reason why this is important is twofold. Number one, if somebody buys your business on July 1st, right, a month later, they have $40,000 of obligation that they have to continue to fulfill that they're not going to get any money for because the CEO took that 50 grand out of the business already. And this becomes really problematic because at the time of sale, CEOs get really indignant about the fact that they've sold it. It's their money. They shouldn't have to give it away. Do you see that often?
All the time. And where this becomes problematic, Todd fortunately gave a fairly simple example, but when buyers are even if a buyer is doing a deal as July 1, they're probably looking at 3 years of historical financial statements. So they're looking at, most companies are on a calendar year. They're looking at 12/31. So in that situation that you just described, Todd, as you know, the odds are there could be a whole bunch of deals out there that are partially or complete or maybe just started where the money just got received. And so there's a bunch of revenue that's been recorded in that year that really belongs on the balance sheet as a liability yet to be fulfilled. Moreover, prior balance sheets are going to be misstated as well. So not only the most recent balance sheet, but the ones before that. And you have to look at, you have to first calculate what that deferred revenue should have been at the end of each year, look at change between the end of the previous year's balance and the current year. That's what really affects the current year's real revenue. And I want to add one other, before you say it, you just gave a simple example. We know that in a lot of these projects, there are multiple aspects. And without getting
It's
into
not right. I way oversimplified that.
Yeah, you have to get into looking at how many performance obligations there are, whether they're fulfilled at a point in time over a period of time. So you have to analyze contracts. You might have web development as a one-year project, develop a website. Then you might have ongoing hosting. You might have provide other connect services to connect that website, such as data mining.
Hey, Don, right. You may remember a few years ago, we worked with a group in Boston, and they did digital marketing, and they did pretty good sized web development projects. And so a web dev project for them was 70 or 80 grand. So again, I'm going to make it really simple. Let's say it's $72,000 for web development. Clients would say, no effing way I'm paying that. They'd say, hold on, we'll build the web. It'll take us 30 days. You pay us $6,000 a month. Yeah. Right. So think about that for a second. It's the opposite example of what I just gave, right? You did all the work up front, but your revenue stream is going to come over a period of time. When you went through that, if you remember this case, when you went through it with the client, we found an additional $800,000 of revenue that they applied to the prior year that should have been in the year we were selling. So all of that dropped right to the bottom line. We had an additional $800,000 of EBITDA. That business was selling for 7.5 times EBITDA. They were huge fans of yours, if you remember that.
Right. But Todd, you just reminded me another one where we had a company that was doing web development as well as a number of other things, hosting and all that. But on web development, they were getting paid. The projects were relatively short term, but they were giving customers pay. They were essentially in the lending business. They were saying, we'll do this web development in 3 months and it'll be done by the end of the year, but you can pay us over 2 years. Well, that's financing. I mean, under GAAP, that is financing. You become a lender to your client. And what you now this gets complicated. You're supposed to discount those payments to their present value. That's the revenue you get to recognize. And then as you collect the payments, you have an element of interest. We had a deal fall apart because they had so many of these clients where they were doing that. And they had a sophisticated buyer with a national firm representative on the due diligence side that came in. And after we told them this was happening and this was going to be a mess. And then we tried to help them fix it. They were recalcitrant.
Here's the point, Don. That doesn't have to blow up your deal. But if we know it up front and we can present it and tell prospects about it, or even put it in the deck, and then we can sell it as a strength, not try to explain it during due diligence as a weakness, makes a huge difference. So
absolutely.
Let me give one last example, and then I want to move on because I got a couple others and I'm keeping my eye on the clock.
Okay.
So we have a client, lots of clients that do SEO, pay-per-click, performance marketing work. They sign up a client, and like a well-run business, let's say they bill the client $6,000, $7,000 a month, they get paid on the first of the month, and then they do the work during the month. But they're not going to do any work unless they get paid up front, right? They're not going to start chasing people. Right. It's a great way to run a business. Right. However, we closed the deal, let's say on June 1st. They get that income that came, or let's say in this example, they close on June 2nd. The money came in. Yeah, the money came in June 1st. It's not their money. It goes and now every entrepreneur listening says, wait a second, what are you talking about? Right? So here's what I'll do. I'll close in at the end of the month. Well, if you want to close on the 30th, you absolutely can. And now you start to get the concept, right? Because the concept is if you close on the 30th and the new company owns it on the 1st, when that credit card batch hits on the 1st, it's Newco's money anyways. And it's going to pay for the cost to produce the services for the month going forward. But if you've got 50 or 150 clients and you're taking a full month's revenue, that's an eye opener to a lot of guys, and it makes them angry because they don't understand it.
That's exactly right. And I think it's worth saying that that buyers more often than not are going to be larger and more sophisticated than sellers, because buyers are typically
That's a
trying
great point.
to create a conglomerate of sorts to add critical mass. And they will tend to have professional advisors on the accounting side, and then these buyers will have learned themselves all of this stuff that we're talking about. They know it. Their professional advisors certainly know it. And when I'm on a buy side, I mean, I can spot some of this stuff in 10. Okay.
And so let me give one example of that, and I'll let you run with this one. Let's talk about vacation time for a second. Right. So, well, why don't you talk about the obligation of vacation time and the things you see?
In fact, why don't we combine that with payroll? So, sellers, entrepreneurs tend to think in terms of when I say entrepreneurs, I mean the C-suite guy, the owners. Okay, they should be getting some help from their accounting staff, but because their accounting staff is often just a bookkeeping staff or an outsourcing firm, and then there's some good outsourcing firms. We have an outsourcing department, but there are a lot of smaller ones that are really just, hey, I'll keep your books for you and do your tax returns, and they don't have the same concerns in mind. They aren't anticipating that buyer's selling. So companies routinely forget that, okay, look, if you pay on the 50th, let's say a lot of companies these days are on a semi-monthly payroll. So they pay on the 15th and the 31st. Often the payroll on the 15th is for the last period of the prior month. So I'm going to go to December 31 now. So your employees that have worked through December 31, you don't pay them until January 15th. Well, that's an accrued expense at the end of the year. They earn the money in the previous calendar year, and that needs to be accrued. And the same is true for every previous year. You got to go back and fix all that.
So let me
just side of that same coin. They tend to think of it. Entrepreneurs just think of, okay, yeah, my people have leave, it's accrued. Some of them carry it over, some it's use it or lose it. But if you have carryovers, you've got to book it as an obligation.
So let me say that in entrepreneur language to make sure I have it. You were talking about the end of the year. Let me talk about deal close. So we close oftentimes you'll close on a pay cycle, the 15th or the 30th. So when we close on the 30th, or let's say on the 15th, right? So we close on the 15th of the month. And I just made payroll. Payroll, right? That payroll, however, is going not for the 1st through the 15th. It's going from the 15th to the 30th of the month prior.
Right.
So, for example, because when I started the company, all of my employees worked for the first 2 weeks, and I didn't even pay them. I waited 2 more weeks to pay them, right? And so now that's coming home to roost, if you will, because a buyer is going to say, well, you haven't, there's an obligation for those from the 1st to the 15th. You haven't paid them yet. I did. I just paid them on the 15th. You're saying that's not for that pay cycle. It's for the one before that. Is that correct?
Right. That's correct. And really, Todd, there are 2 elements of this. One is you have to go back and correct for all the calendar years so that the payroll expense is properly stated within each year, for one. And that may or may not have a material effect, because it usually has to do with, if your payroll is rising, then yes, it's going to increase your payroll expense in a given year when you report it correctly, and slightly decrease your profit. But here's the other thing that you just brought up with me on this. When you get to close, the buyer is looking at something called working capital. I'm sure you're going to ask me about that. And one of the things that goes in the working capital is, it's what are the current assets, what are the current liabilities. That is an extra current liability. And if you signed up to meet a particular working capital target, and now you get to close, and the buyer comes along and says, oh, you forgot to consider this.
Exactly.
Now you short working capital by that amount.
Right. And so here's what I want to accomplish as the banker, right? So when the buyer asks, hey, are you adjusting at the end of each of these years for payroll? What I don't want my guy to do is say, what was it? I want him to look at the guy indignantly and say, of course we are. What do you think? Right. And that sends a signal a strong signal that, plus all the other little things we're talking about that we have accrued for properly and that we paid attention to and accounted for correctly, and the balance sheet ties from one year to the next, that all sends a signal that, you know what, these guys do have their act together. They're good business people in their profession, but they're also running a good business.
Right. And we just touched on a few of these. I could add 2 or 3 more that are probably worth touching on, that because while they often are not super material to the financials, they are essential in building that credibility.
So let's do that. Let me hold just one sec, because I'm going to make it quick now on the vacation time, right? Yeah. So if you have a policy that is unlimited vacation time, this is not an issue. If you have a policy that says people get 2 weeks or 3 weeks or what have you, and if they don't use it, they lose it, no problem.
Yep.
If you say they can accumulate it at the time of close, the buyer's going to want to see all of your accumulated vacation time, which should be on your balance sheet.
For every year
and you owe them for that. You either owe it to the buyer because the buyer is going to accept this responsibility, or you owe it to the employees because you promised them you would pay them. Right? So that just closes out the vacation time. Why don't you touch on these other couple points? Because we're getting really granular, but I think it's very helpful.
Okay, so 3 that come to mind. One is I'm going to talk about unbilled receipts. Just as you can have contracts where you receive money up front, or you maybe receive a portion of the money up front. We talked about it's not earned until later in the revenue. We also have a thing called unbilled revenue. You may be doing work for a client that is obligated to pay for the work, but they're not allowed to bill it. We want to get that revenue reported as an unbilled receivable each calendar year, or if we're in the middle of a close, the close month.
Right.
Because that's revenue that goes straight to the bottom line.
That's helpful to us, correct.
Yeah. Another one that's more interesting, but nonetheless helps show credibility. So most pre-COVID, a lot of companies, digital marketing companies, tend to be nice, the type of people that have the talent that they in their business. And they typically have decent space. There's usually a rent escalator. All right. Now, under GAAP.
I'm sorry, Don, you said it just blanked out. There's rent escalators.
Yes, there's rent escalators where what happens is that, the lease is designed to go 3% a year automatically. Okay. Built right into the lease. Economic sense. All right. And unfortunately, under GAAP says you can take the total of the rent payments over the lease, total them up, divide by the number of lease days, and strict your monthly rent expense. So your monthly rent expense under GAAP is never going to be equal to what you're actually paying. In the early months, it's going to be higher than what you're paying. In the later months, it will be less than. And that gives rise to a balance sheet item we call perfect. It has typically only a slight effect on the income statement year over year, because it's the delta in these accounts that affect the income statement.
Well, but one good example, Don.
Yeah.
One good example would be if somebody takes office space and they get the first year for free, and now they're in year 3. What you're saying is essentially let's say it's a 5-year lease. So you're paying a rent in year 2, 3, 4, and 5. Which the average over that 4 years should really be divided by 5 years, which GAAP allows, which will bring that expense down, and therefore your EBITDA will go up.
Right. And it might help. Because it's such an esoteric concept, as especially in a podcast. Let me just explain why we have that rule, why GAAP has that rule. Because companies can game, they realized early on, companies could game rent. Okay. So you could sign a 5-year lease with no rent payments for 59 months, and then one big rent payment. Okay. Right. We have no expense for the first 59 months of that lease, and your books would look fantastic. And then you have this giant obligation the last month. So GAAP couldn't figure out a better way to handle it than to say, all right, we're going to make you divide that one payment, and then you're going to record that amount of rent. Not get a cash, it goes in without showing you up.
Right.
That's there. And that lends credibility. We made this adjustment. We thought like one of the buyers.
It really
I can't believe that the guy read the book, Todd. That is
it sends a strong signal. Number one, it makes due diligence a ton easier. Number two, and you also get a lot of extra love during due diligence because you build up this credibility where the buyer knows you're going to tell them good, bad, and ugly because the buyer's going to find that out, right? They're going to spend a lot of money on a quality of earnings report and everything else.
To find your stuff in minutes.
Right. So, Donnie, let's do this because, this was a great call. We could go for much longer. I hope it was helpful to our listeners. I think we're going to have to make this be 2 calls. I think we're going to have a second session somewhere else because, quite frankly, we got into some really valuable things that I think are very helpful, not only for transaction, but for entrepreneurs to realize there's a level of accounting rigor that needs to be followed that is helpful in understanding your business, let alone getting a transaction successfully closed. So I will say thank you for as much as you shared today. It was super, super helpful. I am going to have you back on a future episode because I still got a bunch of notes here that I want to get to. Again, Don is with Cohen. You can find him at ecohen.com. You can find Don on LinkedIn. You can reach him through me. But Don, it was great to have you, and I appreciate you being part of our show.
Okay. And I look forward to being with you again because there is a lot more we can say about this. And some of it at a high level, and so I appreciate the opportunity.
You bet, Don. Thank you.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.